Well, welcome everyone. Thank you for joining us. This is our first of what will be many market updates here for you. So Jay and I wanted to take a few minutes just to kind of give you guys some perspective on what we're seeing out there in the markets. There's obviously a lot going on today in the world and in the stock and bond markets and whatnot. So basically, I think the thing that we've been talking a lot about is that you can't really talk about what's going on in the markets today without really talking about interest rates, and therefore we're really talking about the Federal Reserve. So one of the things that we've, talked about quite a bit here, and I'm going to go back and forth some just so you all know between sharing my screen and not. So one of the things that we've definitely been talking about here as it relates to interest rates is what is the Fed going to do this year? That was kind of all the talk last year as well. I think it's going to continue to be the theme this year. What you're seeing here on your screens, this particular chart that we're showing here, what it really shows is the probability that the market has priced in on when the Fed would begin to cut rates, or when they would have that first rate cut, if you will. So the way that this chart reads is it's kind of like a timeline. So from left to right, you basically have the first of the year through, I think last week, March or April 19th, I think was the date here. And what you see is that in the green line, it was to start the year, you can kind of say, what was the probability that the market believed the Fed was going to cut rates at their May 1st FOMC meeting? The blue line becomes the June meeting. The red line is the July meeting, and the orange line is the September meeting. So the real gist of this chart, I think, is, as you can see, that as the year has gone on, nobody thinks that there's 5% of people, I guess, that still believe May 1st we're going to see the first rate cut. There's only now 18% of people that think June is going to be a rate cut. And you can basically see that even July now has dropped below 50%. So as the year has gone on, we have basically, as a market, as a whole, basically really lowered our expectations on what the Fed was going to be doing this year. So go back to December, the market was really pricing in 6 to 7 rate cuts this year. As you can see, that has drastically kind of changed in terms of all these probabilities falling. So from now, it really does look like, as Jay and I have kind of said for some time, higher for longer is the most likely kind of scenario here moving forward. So from there, we say, well, what's really driving this? Why is the Fed doing what they're doing? Why are they, prolonging these higher rates? Why are they not going to start cutting as soon as the market would like, if you will? And I think the big reason is inflation continues to be an issue. So what you really see on this chart, some of this data just came out this morning, these next couple of charts, but today we did have what they call the PCE index data came out for the quarter, which is the personal consumption expenditure, is basically what that stands for. And what it is it's really the Fed's favorite inflation gauge, or more specifically the core PCE, which strips out things like the more volatile pieces like energy and food come out of it. You get the core PCE. Basically, that came out today up 3.7%. To put that in perspective, it was just 1.8% in the fourth quarter. So again, this is a first quarter number. PCE was up 3.7. It was only expected to be up 2.7. So this was data that came out this morning. This is part of why we are seeing a market sell-off today, is everybody saw inflation come in really hot once again this morning, well above expectations. As you can see on the chart, even for most of this year, it's a rising number that's kind of getting to a place that we're not looking to be. For those that don't follow this as closely as we do, the target that the Fed is trying to get to is 2%. So when we look at that orange line going across, especially the dotted orange line, we're really hoping to get that closer to 2% is what the Fed's goal is. So it's clearly running in the wrong direction currently. So it's hard to see the Fed cutting rates in our belief when you do have, inflation continuing to be a problem. And that was the whole reason they were raising rates in the first place. The other data point that came out this morning was first quarter GDP for the economy. It came in at 1.6%, as you see there on the bottom right. That was kind of like the prior number, on the wrong side of what was expected. So what everybody was expecting on that particular number was a 2.4% GDP number for the first quarter, and it came in at 1.6, so quite a bit lower than expected. Now, there are typically 2 to 3 revisions to these GDP numbers. So just because it's 1.6 today doesn't mean in a few weeks they won't revise the number up to, something closer to that 2.4 target that the market was expecting. But nonetheless, GDP did kind of disappoint this morning. So this morning we kind of had 2 data points that have basically caused the market to sell off a little bit. Basically, we're seeing slower growth out there in the economy, but also at the same time, prices going up still. So there's a term out there that we've heard a lot in the financial media that kind of relates to that situation where growth slows, but inflation continues, and that is called stagflation, if you've heard of that. That's kind of what that tends to point to, which isn't a good place to be. You don't want to have prices going up, but the economy not thriving so that we can all afford to pay those higher prices, if you will. So the way that we would kind of go from there to show this relationship between stocks and interest rates. This chart's a little busy, I guess maybe you could say, but what it really shows is in the purple line, you get the S&P 500. So we're really looking at since the beginning of 22 on this chart. So what we're trying to show is about when the Fed started raising rates. And so in that orange line, what you're going to see is the 10-year Treasury rate. So what is the U.S. Treasury bonds from a 10-year perspective? What are they yielding, or what is the interest rate? And what you kind of see on this chart, it's not a perfect mirror per se, but I think you can get the gist of it pretty well, is when rates were really shooting higher from the beginning of 22 up until, about halfway through 22, you saw the market falling off. As rates then from kind of the second half of 22 into really most of 23 kind of went sideways. They definitely went up and down, but for the most part, they trended, you could see to the side there. Stocks had a pretty good bounce back. So this was last year why the stock market did so well. Part of that was bouncing back from a bad 22. But then you also had, interest rates really stopped going up. But then you can see pretty much right around July of last year, you start to see them kind of separate again, where interest rates really took off higher again, causing the market to kind of sell off. Well, then once you got to, I think if that's October, November-ish, where you see that peak in the 10-year yield, as soon as it started really falling all the way from almost 5% down to 3.9, stocks just took off. That's what really drove a big part of this rally that we've had going back to Halloween, Thanksgiving time period, when we've kind of had one of the stronger runs here in quite some time. So it's been a very, very strong market up to this point, up until about a month ago or so. As you can see on here, you started to see rates really go up again. So now you're at about 4.76, I think, today. This chart's a day old, if you will. And so we did see rates go up quite a bit this morning on those 2 data points that we talked about earlier. But basically, what you can see on this chart is just when rates really have taken a big move one direction or another, it's absolutely had a pretty direct effect on stocks. To us, though, and this is something Jay might chime in on a little bit, but we do think things still look pretty good out there for corporate America. So what you see here is basically the S&P 500 companies, the year-over-year earnings growth, the profit growth, so to speak. And so over the long period of time, if you said since the year 2000, 2001, I guess, what has the average been? The average has been about 7.5% growth for the S&P 500 companies. If you look at really since 2011, since that big spike up in 2010, we really haven't had that many double-digit positive years. We've kind of had some muddled economic years in there. We've had a couple of big years, a handful of down years, with COVID, and even back in 22 and 23, we had a little bit of a profit recession, as some called it, for a few parts of the economy, a few types of companies. But for the most part, what we're expecting moving forward is actually pretty positive. So what you see on the far right of this chart is for 24, the market's expecting profits to rise 11%, which would be, you could say well above average. And then for the next year, rising even further, another 13%. So looking forward, the expectation currently is that the large companies are weathering these higher rates, weathering the inflation, and they're actually able to, pass all that on to us, if you will, as consumers, and continue to do pretty well.
And to Chad's point, I think that really shows the importance of the companies that you're in, not the market as a whole, so much as the actual companies that we're in. And so that's been a big plus for us, so that we still believe that you buy the best companies with cash flow, very good cash flow, low debt, and that will help you weather the storm during this type of higher interest rate environment.
So to Jay's point, not every company is created equal. Let me go back one. What you see here along the top is the percentage, or the percent of the companies in these kind of three cohorts: large cap, mid cap, and small cap stocks. So think of that as just the size of these companies. The very large companies in gray bars, the mid-sized companies in green, and then the small companies in blue. The percentage of them that are unprofitable. So what really sticks out to us on here is how few of those large companies are unprofitable today. So if you are thinking about in that large cap space, it's just like that prior chart. It's the S&P 500. 90% of those companies right now are profitable. You go back to some prior time periods of market stress, like the tech wreck, as it says here, the dot-com bubble back in 2000, the financial crisis back in 2008, and then even more recently, the COVID pandemic. We came into those with a lot more unprofitable large companies. When you look at the small companies, you kind of see they're pretty consistently big chunk of those that are unprofitable. But even the mid-cap companies are more profitable today than they were in those past issues. And then on the bottom, we think this is pretty important because we've talked about this a lot, is the interest rate coverage ratio. Really what that speaks to is how much profits do you have as a business to be able to easily service your debt. So everybody's got, some debt out there. It's kind of like basically comparing your income to your debt service costs or your interest payments, if you will. And what you really see is that the gray line down there has really risen over time, which tells us that these companies can easily pay the debt that they have. They can easily pay the interest rates. So even though rates have really risen in the last couple of years, it really hasn't affected these large companies that much. Whereas the small companies, they have a much thinner kind of margin, if you will, to be able to handle that debt. And so they're trading, their profits right now are less than 2 times kind of what their interest, or debt service ratio coverages are. So basically, this to us is, just why we believe in the big companies right now are the best place to be. So there has been a lot of talk this year about the small companies and how attractive they could be in some of these areas. We think that could still come to fruition, but it would likely take something like lower interest rates and a strong economic growth environment for those small companies to probably have a good bounce back here. One thing, some of you might have already seen this chart. We've been talking about this for a few months now, but what this shows is how many times the market in a particular year made a new all-time high. So that's kind of what the ATH is, their all-time high. And the reason we show this is earlier this year, back in January, the market hit a new all-time high. And we often have people getting nervous when the market is making new all-time highs. Now it's obviously here in the last month fallen back some, so it's not, making new all-time highs today or tomorrow, most likely. But year to date, we've made 22 of those as of the end of March. And so it's been a very strong year, so to speak, for making new highs. And historically, what happens when the market makes new highs, especially if it hasn't made a new high for at least 12 months, is it continues making new all-time highs. It's like there's a reason you can go back, 40 years and the Dow Jones traded at 1,000 or whatever it was, and, has gone up 30, 40x since then, is the market does go up over time. So in a sense, this is a little counterintuitive because we are all taught buy low, sell high. So to some extent, when we we see people get anxious when the market's hitting all-time highs, but our message is, believe it or not, when the market's hitting new all-time highs, what does tend to happen is it just keeps making new all-time highs. You often see those years really cluster together. Kind of along those same lines, what we've got here is data going back to 1960, showing when we had a first quarter where the stock market was up 10% or more, what has tended to happen the rest of the year. And what you see on here is there was really only one year, 1987, that shows up on here in the far right column that was negative the final 9 months of the year. So some of you will remember the crash of 87. That definitely was a big part of that. But what a lot of people don't realize is that that year still finished positive because we were up 20% there in that particular first quarter back in 87. So even though you did have a pretty big sell-off there in the last part of the year, it was still a positive year nonetheless. So with that said, 90% of the time in these scenarios, and we always have to say, you know, past performance is no indicator of future performance here, but if history is our guide, we look at that and say the odds are with us that historically, when the first quarter has been very strong, the rest of the year tends to be pretty strong as well, even if April isn't, you know. So you do see 4 different down Aprils, which would kind of go along with what we're seeing today, but that doesn't necessarily mean, you know, in our eyes, bad times are ahead. So the other question we seem to be getting a lot, and I'm sure everybody on here is aware we are in an election year. So I know the commercials haven't gotten going like they will, but we are in an election year, and that makes a lot of people nervous. I think there's always that uncertainty out there. No matter which side of the fence you sit on, I think everybody gets worried, well, what if the other guy gets in or the other lady gets in? What tends to happen is the 4th year of that presidential cycle. So this chart really breaks down the presidential cycle into the 4 years, year 1, 2, 3, and 4, and how has the market done in those years. The top line that is more purple, if you will, that is kind of going up to the very top, that is all years, if you will. So what you get there on those, the average year, and this does go back to 1900, so there's a lot of cycles in here. But the 4th year tends to be a pretty strong year. The 3rd and 4th year, both, in fact. And a lot of the reason behind that, as we say, is people want to get reelected. There's usually a lot of policy going on in year 4 that is a little bit more on the stimulative side. People aren't really trying to upset the apple cart too much in these election years. What you see on the bottom of the chart, though, is kind of the more pinkish shaded area there is the years or the cycles, excuse me, when the 2nd year was negative. So for us on this particular go around, when you see the black line going through there that stops early in the year 4, you do see it was down in 2022 or that 2nd year of the cycle. So 2022 was a bad year for the market, as I'm sure most of you remember, as was, let me back up. So when you have those down 2nd years, what tends to happen? And so that's really what that pink line shows. The black line is really following almost lockstep with the average of when there's a negative 2nd year in the 4-year cycle, if you will. So we do think that the presidential year, as much as it does put a lot of people kind of in a nervous posture, it does tend to be good for stocks. It can be, you can kind of see on some of these where you do see a few dips here and there where the market does tend to, you know, at certain points, maybe in the cycle, have some setbacks or something just before the election when maybe nerves really start to get, you know, heightened, if you will, but then it does tend to finish the year pretty strong. And again, this is all historical data, doesn't mean anything about the future necessarily, but we do think there's a pretty strong trend with some of this historical data. So we haven't really talked about bonds much, but this is, you know, again, a little bit of a messy chart, but really what it's showing is the Barclays, or now I think we call it the Bloomberg AG or aggregate index, which is basically the most broad index we have for the bond market. So that was created in 1976. So basically every line that you see on this chart, and they all kind of clump together in the middle there, but they represent a different year since 1976. And basically, how did the bond market do in that particular year? As you can see, the very top back in 1982, for those of you investing in bonds back then, the bond market was up 32%. I mean, talk about a massive upside for the bond market. The reason that happened is rates came down significantly in that year. So bonds will tend to have a very inverse relationship to interest rates. So what we've been seeing this year is, again, rising rates. As everybody's realized, maybe the Fed's not going to be cutting rates. Inflation is continuing to be an issue. So you do see the blue line down here on this particular graph through April 15th, showing that the index was down about 3% this year. The red line all the way at the bottom was that year of 2022. So some of you probably saw this back then. We had a similar chart we were showing, but you can just see how much of an outlier that 2022 was. But as long as, we do continue to have interest rates trending higher, it's not positive for bonds. The other thing I would mention here, and Jay, I don't know if you have anything to add, but most of the lines on this chart do tend to be above the 0% mark. So most of the time since 1976, bond returns have been pretty positive. Even up until that 2022, there wasn't even a year on there that was down more than 5%. However, what we would kind of point to here is, and I don't have a real good chart for this per se, but when we have had really since about 1980, we've only had interest rates drifting lower. So it has been up until 2022, a very big bull market for bonds for about 40 years. So for about 40 years, interest rates trended lower. Some of you had a mortgage that you got back in the late 80s or in the 80s or late 70s, I should say. I know a lot of you had told us about your first mortgage at 12%, 15%, 17%, stuff like that. You could probably relate to that. Up until about 2022, you mostly saw through the last 40 years, interest rates slowly declining, if you will. So basically that tends to be a very positive environment for bonds. But however, when it does flip and interest rates really start taking off higher, not a good environment for bonds. So we have seen, bonds continue to struggle a little bit this year.
And to Chad's point, that's also why even when you look at the Fed making rate cuts, which we think at some point, maybe they do a quarter this year, we're probably in the camp that they won't. But if you push it out to 2025, it's not going to be aggressive cuts unless there's something truly negative going on in the economy. And that's because we're not at an incredibly high, from a historical perspective, interest rate environment. We just have been in an incredibly low interest rates environment for a very long time.
Yeah, that's a great point. When you really look at how much these rates have risen, to a lot of people, this feels abnormal, to get to these high interest rates. I think car loans these days are 8, 9, 10%. That sounds crazy, but it's because of the last 15 years where we were kind of at 0% interest rates. So to Jay's point, the 0% world that we were in for so long was really the abnormal period. Where we are today is pretty close to some long-term averages, in fact. When we look at the consumer, so that's kind of some data on some companies, some bonds, just some general interest rates, things of that nature. But how does that affect the consumer? So when we think about the inflation story, when we think about the economy, it's a very much a consumer-driven economy. So the thing that really sticks out to us is that this unemployment rate, which is the gray line here, is still trending close to historical lows. 3.9% as of the February reading, which is still, pretty darn low. I think the 50-year average you can see up there is a little over 6%. So most people are employed if they want to be employed today. Also, in the blue line, you see wage growth, which over time has averaged 3.9%. That peaked more recently up close to 8% back in 21 and 22. Today, it has fallen back quite a bit as the labor market has kind of normalized a little bit. As you can probably all remember, a couple of years ago, nobody could find anybody to hire. So it definitely became kind of an abnormal labor environment, but it has started to normalize a little bit. However, we are still seeing wage growth above the inflation rate right now. And so the reason we think that's important is if people are getting paid a little bit extra, more than kind of they're used to, they can likely, and we're talking in generalities here, but they can likely afford to pay a little bit higher prices. And so to some extent, the consumer is getting a good kind of boost today in their paycheck. The other piece to the unemployment thing is what this chart really shows is looking back at the last 3 years, kind of two different numbers on the screen. At the top, it is the 4-week moving average of initial claims for unemployment insurance. So how many people are signing up for unemployment? We have not seen this number budge very much. I mean, it's been extremely flat for the last 12 months. I mean, it really, as much as everybody's kind of expected some slowdowns and stuff with these high interest rates, we really haven't seen unemployment claims pick up a whole lot. I mean, we've seen a lot of big companies announce layoffs here and there. However, on the aggregate, it hasn't really taken hold. On the bottom, you get the continuing claims, which are kind of people that tend to be on there for a period of time, not just the first timers, so to speak. And you do have 1.8 million people still collecting unemployment insurance, but that number, again, really has stayed flat for quite some time. So without seeing these numbers really start to pick up, we still feel like the consumer is kind of holding their own out there. One thing that we talked about a couple years ago was how much money people saved during COVID. And so when you look at this top chart, what we kind of point to is that shaded area was the excess savings. So at one point during COVID, we got all the way up to $2.3 trillion in excess savings, kind of above and beyond what would have been normal, if you will. And so while people have had to dip into that extra savings, as you do see it coming down really since it peaked, pretty consistently coming back to normal, there is still a gap there. So there is still some excess savings in people's bank accounts. I think when you look at the chart on the bottom, it kind of tries to take that data and chop it into income percentile groups. And so for the most part, everybody except the bottom 20% still seem to have a little bit of savings out there. So to us, we know that this economy's not been great for everyone. It never really is, right? There's always going to be, some part of the public that, is struggling. And there's no doubt that the inflation that we've had here over the last couple of years has definitely hit, the lower income folks really hard, especially those that don't own assets because they're not getting the benefit like so many of you have of higher stock prices, higher real estate values, things of that nature. So we always do say inflation's a very regressive tax on the poor, if you will, which is why Powell and, people at the Fed really are trying to kind of stop this inflation and kind of have this battle that they're waging here. So basically, we still think people are sitting on some cash, which is a good thing. People really aren't quite strapped. Number of consumers with new foreclosures and bankruptcies. Same thing. I mean, this is a 20-year chart here, and you're really not seeing these things pick up very much. So these are the kind of things we're looking for kind of some clues that maybe, there's some things breaking out there with the consumer. But for the most part, people are kind of hanging in there. I think the higher wages, the higher stock prices, those kind of things are giving people the ability to keep their head above water. Just since going back to maybe one of those first charts we showed when the Fed kind of pivoted and started talking about all these rate cuts they might have in 23, and they were feeling pretty good about their inflation battle back in the fourth quarter. I think it was that November FOMC meeting. I forget exactly how Powell put it back then. Jay, maybe you'll remember, but he said something just about how they might even be able to start lowering rates before they get to their 2% target. And so that just got everybody really excited out there in the market. That is really what sparked this huge rally we've had since then in stocks. And so what you've really seen is, and this will be a little bit lower now because this is about a month old, this chart, but and we have seen the markets pull back a little bit, about 5% or so, but there's close to $13 trillion created out there in wealth, just from the stock and bond market rallying the way that it did in those 5 months or so. So when you put that in perspective, I believe the total spending by consumers in the economy last year was only about 16 trillion and change. So 13 trillion is just a massive increase in wealth that we've seen here in the last 5-6 months.
And then one of the things that you really see right now is that because you are getting higher interest rates, and Chad and I were talking about it this morning again, you have more income being generated off of those assets. And so it continues to keep that cycle going of more dollars flowing into people's pockets that they then have to invest or spend in the economy, et cetera. And that's why we think you're seeing the economy stay strong, is because now people have gone from a year and a half, 2 years at 0.5% in money markets to over 5% in money markets. And that tends to be a lot of extra dollars flowing into people's pockets.
Yeah, there's a lot of you on here. We know that have sat on a lot of cash historically, and for most of the last 15 years, 16, 17 years, you haven't gotten paid barely anything on that cash. But all of a sudden, flip a switch and you're getting 5% on that cash, or are able to. That's a big, big difference, getting paid out in people's pockets, as Jay said. So there are positives to it, to these higher rates, but not necessarily for everyone. We think sometimes the psychology of the consumer is important. We thought this chart was just kind of fun. I know that, we're kind of nerds, but this just showed the percentage of people planning on taking an international vacation in the next 6 months. To some extent, what we kind of believe here, Jay and I talk a lot about this, is we think COVID really changed people. I don't know how many of you out there would raise your hand and say that's me, but it really seemed like when COVID took so much away from us for a period of time there, whether it be travel, experiences, things of that nature, when we were able to get back to life, that was the stuff I think people are really prioritizing, getting out, seeing things, spending more on experiences than personal goods, and so I think that to some extent is probably reflected in this chart, probably some pent up demand where people didn't get to take those, European vacations, or, wherever they might have been heading on some cruises or other things for a handful of years, and now they're finally getting to go. But there are, it's kind of wild just to see the sharp increase in this number, or even compare it to the 90s, how few people really traveled internationally back then. When we kind of talk about risks, what do we see out there as true risks? The biggest risk that we talk about that's kind of right in front of all of us is what we're dealing with, here in the last month, or even just today, is inflation continues to be a problem and interest rates have to keep moving higher. If that happens, that's got all these kind of implications that we've talked about a little bit. But another implication of that is, looking at the U.S. Treasury debt, the government debt issue. So, we're not trying to be political here in any way, shape, or form, just looking at numbers. What we would say is, when you kind of look at this chart, there's kind of three main things going on here. In the blue shaded area, what you have is the total debt. So that right now is somewhere around $34 trillion, okay? So back up in the purple line there, what you see is the interest paid on the debt, the actual dollar amount that we pay in interest. And then in orange, what you see there is the 3-year Treasury rate. So we use the 3-year rate on this particular chart just because the Treasury, most of the debt comes due in the next 3 years. Believe it or not, even though rates were really low for a really long time, as you see there, I mean, below 2% for most of the last 15 years, you could argue, just looking at this. The government didn't really lock in that debt. Most homeowners locked in a 3% mortgage, but the government didn't lock in, all of that $34 trillion at, 2% for the next 30 years or something like that. Most of it was very short. Whether there just was an appetite out there in the marketplace nobody wanted to buy a 30-year Treasury at 2%, or what the reason was. Most of it's coming due. And so what you're seeing happen over the last year and a half is, as the Treasury debt comes due and they're having to refinance it, because, we're obviously not paying it off. We're getting it at higher interest rates. And so we're seeing this purple line just go straight up right now. And I think it's showing on here about 882 billion that we're paying on interest at the moment. I think that's actually expected to be now crossed $1 trillion, if I'm not mistaken. But the reason we think that's important is it has to do with government spending. You know, if the government gets to a point where the rates keep going higher and all of a sudden that purple line goes all the way up, say to the numbers we were kind of leaning on, where if you took that whole 34 trillion and put a 4% interest rate on it, which is really lower than where we are today, but it's pretty close to a long-term average, you would have something like 1.3, $1.4 trillion in interest expense only for the US government. So the reason we think that's a big deal is if you went back just to 2019, it was somewhere around 550, 550 billion, I should say. So that increase, if you will, is almost equal to the entire purple section here in the middle, that non-defense discretionary bucket. So the way that we're talking about this is the interest could easily grow just in 5-6 years by the same amount that we have for our entire discretionary budget. So to us, there's a chance here that you see, and we've kind of seen some people on the right in the House try and pull some of these levers to try and pull in spending. Jay and I really don't believe spending is going to be cut this year. It's an election year. We think the party will continue, if you will. And, regardless of what we might think about the long-term implications of some of this stuff, what we would say is when you spend, I think the number I heard the other day was that we're adding $1 trillion to the deficit every, every 100 days, I think. At that rate, regardless of what you think the long-term thoughts on that are, or what side you might sit on that discussion, we would say the short term, that's positive. I mean, if you're dumping an extra $1 trillion into the economy periodically, there's no way that doesn't stimulate stuff. And so in a way, what we're really seeing is what's going on with the purse strings in Washington, the fiscal side of the house, if you will, the people kind of spending the money, is they're kind of working against the Fed here, because the Fed is raising rates. They're trying to slow the economy. But at the same time, we're spending so much money into the economy that it's kind of offsetting it. And so we do believe that's a big part of why the economy has been as strong as it has in the face of these higher interest rates is the government spending. So if we got to a point, and again, we don't think this is this year, it might not even be next year, who knows, it might not be for 20 years, to where the government were to say, interest rates are killing us, this cost of the debt's killing us, we got to get our house in order and really lower spending, it would kind of have the opposite effect of what it's having today. So if you pull $1 trillion out of the economy, surely that's got some short-term pain to it, is kind of our thinking there. So that's something that we're watching, just because it is such a big difference at the moment when you look at how much of that government finances are really having to go towards the debt expense, if you will. So that was really the extent of our kind of presentation here, our talking points. I do see, let's see here. Okay, I saw one question in there, but a little unrelated. So it looks like maybe Jessica took that. So if anybody has any questions, feel free to type them in there to the Q&A. We'll give you a few seconds here. I know we just ran through a whole bunch of stuff, but to the extent anybody has questions, we are here and happy to answer them. Maybe we just did that good of a job of laying it all out there, Jay.
Well, I'll throw a question to you, Chad. So with all that being said, what do you see over the next, 6 months and 12 months? I'll ask it as an observer and not give you the answer that you already know I have. So I'll let you speak to that. But if you look at the next 6 months, 12 months, what are you kind of looking at in terms of the markets, equities and bonds?
Yeah, I think what we often seem to talk about is it's kind of interesting because the market has had, when you kind of go back to the last couple of years, a number of these kind of stops and starts with interest rates kind of having a short-term spike. What's happened over and over again is, and honestly, I think this started back in the summer of 22. We were talking about this, where the Fed had just really started raising rates back in 22. But even by late summer, I think it was, people started talking about maybe they'll be able to quit raising rates by year end. So by 22, that optimism in the market of just the Fed stopping hiking rates and maybe starting to, early 23, they could start to lower them. That really seemed to be all it took to get the market excited again, was kind of this outlook that rates would be coming down. So to some extent, we've had a number of these cycles where the Fed has kind of gone back and forth on, are they talking tough about inflation, or are they kind of talking like maybe we'll be able to start lowering rates soon? You've really had these big market moves off of those. And so right now we're kind of seeing the opposite, where things are dropping based on everybody looking at this inflation data and thinking, things could continue to, for the Fed, continue to be a tough battle where maybe they even have to raise rates, which I think would put the market in a pretty good probably pullback. But with that said, kind of beyond that, we are just seeing so many companies doing well right now. One thing, we're right in the middle of earnings season. This is the time of the quarter when all the companies are reporting how last quarter went. And one thing, Jay and I have been talking a lot about is it seems like, I don't have a number to put to this, but it seems like a very large majority, at least of the companies we're following, of the results have said double beat. And what that tends to mean when we say double beat on an earnings is the company was expected to have revenues of this, and they were expected to have earnings of this. So kind of revenues or sales and profits, where whatever the market was kind of expecting. Well, when they turned in their results, if you will, the report card, they were better than revenue expectations and profit expectations. So we've just continued to see many, many companies beating these expectations on both the top and bottom line. And so in many ways, we do feel like the Fed and inflation and some of these things are continuing to be a problem. But at the same time, corporations are making quite a bit of money right now from what we're seeing. So we do still think it's more likely to be positive, in our opinion, for the next 6 to 12 months than negative. So we kind of view this 5-6% pullback going on currently, hopefully, as just that, a little bit of a reset, because we had gone up so far so fast. I do see a question here. How's the new office setup going? It's going great. We are really kind of loving our new digs here, if you will. So do you see surplus cash in hand as going toward market investments or cautious CD / banks? That's an interesting question, because we do, you see, if you turn on CNBC, you hear, people saying this all day long. A lot of people are always talking about this cash on the sidelines and will it come back into the market? And I don't necessarily know if we think that is really something that is going to happen. I think a lot of the time, and I think we can use a lot of you as a barometer, not a lot of people necessarily go back and forth between stocks and cash. We will see most people have their cash and they're comfortable with it, and it's kind of a security blanket, if you will. So I think we don't tend to see a lot of people take that money and go take a bunch of risk with it. But what we are seeing is a lot of people waking up to the fact that the bank is still paying them, 0.1% on their savings account, when the real going rate out there in money market funds and 1-month treasuries and really, really safe short-term assets is more like 5%. So I think what we're really seeing is people say, what are my cash alternatives, while still staying pretty safe, if you will. So I think that is probably more likely than not to be the story, is just, cash will likely stay cash to some extent. I mean, maybe you got a different take on that, Jay, to add to, but I don't know that we often see people going back and forth in major ways between stocks and cash. But
no, I do think where it comes in is a comfort level, right? That's your your safety blanket, and your safety blanket is growing at 5%, and you feel more comfortable with your equity exposure. I do think that's a difference we've seen, is that people aren't as concerned in getting out of the market and putting money to the side, because their safety blanket is growing at a very attractive rate, and so they're more comfortable with leaving their equity allocation to still remain the same.
Mhm. Now, I think we have seen some people that have just continuing to have, going back to that wealth effect, that have just had dollars stacking up because things have done so well, and they're kind of realizing maybe I don't need this much in cash for different reasons. And so maybe some of that money leaks into the market. But we got a question here that's an interesting one. Is it a good time, Jay, to sell your home, take the profit, and fully invest in stocks? I think you got to live somewhere. I do recall back in 2008, there was one kind of big name bond manager out in California that I remember. He kind of saw, maybe what was going on in California with home prices and whatnot, and sold all his properties and went and rented an apartment. And, I don't know that a lot of people are willing to do that, because you do have to go live somewhere. We also don't necessarily think that home prices are coming down anytime soon, at least around, depending on where you are. I think some areas had a much bigger maybe spike in demand, that they're seeing a little bit of a reset in some of those, real popular places over the last 3 or 4 years in the Sun Belt and the likes. But from what we continue to see, because of this big increase in interest rates, the mortgage rate going from 3% to 7%. I just had something I saw a little bit ago. Let me see if I have it handy. Going back to 2020, so maybe these numbers will mean something here to you, the person that asked it, but the monthly mortgage payment needed to buy the median priced home in the US. Okay, so what we're talking about is just the monthly mortgage payment of the median home in the US. Back in April of 20, it was just under $1,500 is what it took to buy that home. Today, it's about $2,800 or just over that. So it's up essentially 92% over the last 4 years, the cost to buy that home in terms of a monthly mortgage rate. And so because you did have this giant increase in prices or values, and then on top of that, kind of after that happened, you had this giant increase in the interest rates. And so to some extent, homes do look very unaffordable right now to a new buyer from a historical standpoint. However, kind of like we talked about in the beginning, a lot of you had your first mortgages at 12%, 15% and higher. What we're seeing is that in these environments, when rates really go up and the mortgage rate really goes up, people that have a mortgage aren't going to sell their home because they're not going to give up that 3% mortgage. So what we keep seeing around here is, and I think around the country, is supply is extremely low. So you do still have a ton of millennials. They are the largest generation out there by population. And I think they're around, I forget what I just heard the other day, but there's like 10,000 of them turning 35 every day right now or something like that. So that number might be way off, so don't quote me on that here. But basically, a lot of them have been holding off buying a home. They're still looking to buy homes. So we do think that the demand is there to buy these homes, but we don't think the supply is there from a standpoint to really bring prices down. You think you'd have to have the market kind of get flooded with supply, if you will, a whole bunch of people putting their home up for sale. And really, because of what's happened over the last handful of years, people have a lot of equity in their home. If they were there at least 3 or 4 years, they most likely do have quite a bit of equity there. So the odds of them being underwater or kind of having that 2008 scenario, we just don't think is all that likely. Something else that we had looked at, 2 or 3 years ago now, let's see if I can remember these numbers off the top of my head, but we went back and looked at kind of the last time inflation and interest rates got real crazy back in the 70s. And I think it was from 76 to 82, the 30-year mortgage rate went from something like 9% all the way up to 17%. Huge jump, right? You would expect, that to have what we expected at the time, or what we were talking about, was you would think that would have a big negative impact on housing. But the median home price in those same 6 years went from 42,000 all the way up to like 70,000. So it was probably a similar setup to what we're seeing today, where people just weren't about to put their house on the market and make a change. You know, you want to upgrade a little bit. It's not going to just cost you a little bit. It's going to cost you a lot to upgrade a little bit right now, if that makes sense. So I guess to answer that question, we would say if the concern is that this home price might really fall in value or something like that, we're probably not in that camp at this time, at least not around here. So I don't know if that answers that question or not for what you were looking for, but.
And it's a similar story with rents. It's not quite
Mhm.
as stark, but rents are up at one point. This would have been last year. We were looking at, we're up over 40% across the country, and that's probably a little bit higher now. So to Chad's point, you've got to live somewhere. How much you're willing to pay to live in that other place, with the hope that your equity performance more than outpaces that. So that's a big gamble, but I guess if you're willing to downsize to a 1-bedroom apartment, it could probably work to your advantage.
Yeah. So we have another question here. If the government decided to repay its debt, you said it could impact our economy. On a personal level, would it be wise to take some of this surplus cash to repay a mortgage or keep it in cash? Or will you say it depends on the mortgage rate? It absolutely depends on the mortgage rate. So we would typically probably have a little bit of a neutral take on this. I think in years past, probably a lot of you have even asked us at times, should I pay off my mortgage or not? And I think in a typical environment, what you really see with that is the going interest rates. So if we tried to make some kind of apples to apples comparison, and we said, okay, we can guarantee you that the bank's going to charge you that 3% on your mortgage. So let's invest that money in something a little bit more safe and secure. You were probably going to get an investment that paid you something pretty close to that 3%. So there wasn't necessarily a huge obvious answer on should we pay this off. I think a lot of the time that would really come down to personal preference and security. Some people just can really sleep better at night knowing that home is paid off, if you will, or on vice versa, knowing they've got this cash on the sideline, in case something were to come up. So I think in some cases that becomes a little bit more of a personal kind of comfort zone, if you will, on which way really moves that needle. However, in today's world, because of how fast this interest rate environment has changed, if you had the money sitting to the side right now that you could pay off your 3% mortgage with, but you could invest it at 5% in cash, to us, there's a 2% kind of arbitrage there that's too good to be true, because you're essentially, when we talk about cash, you're kind of looking at that as a pretty close to a risk-free investment, if you will, or a 1-month treasury, a 1-year treasury, whatever you want to think of it as, to where, you're looking at some of the safer type investments in the world, if you will, that you can net, 50, 70% higher interest rate than what that mortgage rate is. We would say anybody in that situation should not pay off their mortgage, most likely, because there is a pretty drastic difference between kind of the quote unquote, safer things you can invest that money in relative to the mortgage rate. Some great questions there. A lot of good discussion. Anybody else have any questions before we kind of wrap this up? Of course, we will not be, unavailable from after this. So if anybody does have a follow-up question, you can always feel free to give us a call, shoot us an email. As some of you might know, because we maybe have texted you, all of our direct lines, I'll just kind of throw this out there for you that are listening, you can text. So if you wanted to send us a text at times, just because that's more convenient for you, you can text our direct business lines, and that is some capability that we have now. So it looks like we don't have any other questions coming through, so probably go ahead and end it there. Thank you all for joining us. A lot of you on here listening, so hopefully that resonated with you a little bit. We didn't get too, high level or anything like that, or too deep into the weeds, and we were able to keep it high level, I should say, and people enjoyed that. So thank you all for joining, and we will talk to you soon. Thank you.
Thanks. Have a great weekend.